Welcome back, everybody. So in this video, we're going to be going over what's going on geopolitically a little bit, and then market volatility and the potential for a market correction on the way. So first off, the elephant in the room, the conflict between Russia and Ukraine. This has obviously been affecting the market in the way where it's causing some uneasiness in the market, as well as shooting gas prices up, which does not help the average consumer. But I will say this, the market volatility coming from this geopolitical conflict is only a temporary thing. That's not what's going to send the US stock market into a correction. This conflict will settle down, hopefully in a peaceful manner. And when it does settle down, then that'll be it. And it's not going to cause market volatility. This causes market volatility in the sense of some fear. There's uneasiness in the market because a big geopolitical thing is going on. In the long run, that is not what's going to continue causing market volatility and eventually send us into a potential market crash or correction. What is going to continue our market volatility and most likely send us into a correction is the Fed. In the history of our stock market, every time there was inflation and the Fed used rate hikes and raising interest rates to combat that, the stock market went down. The stock market had a correction. To briefly explain why this happens, you have an economy like ours, inflation is too high, the Fed wants to put a stop to that. So what combats inflation? Well, rate hikes, raising the interest rates, making it more expensive to borrow money. Historically, that has slowed down the economy in the past. It's an intentional sabotage on the economy to slow this inflation down. And then, of course, what happens to the stock market when the economy slows down? Well, it would make sense. The stock market would follow it and also go down. Every time this has ever been done in US history where they've really done big rate hikes and raised the interest rates to combat inflation, we have had some sort of correction. Now, the possibility for bear market, if other things do happen, is always out there, but remember, that would basically have to be a 25% drop or more. I personally don't see anything like that coming. I see the potential for a market correction in the future. Now I want to get into my opinion on what one would do in this market volatility and this uneasiness in the market and the potential for a market crash or correction coming. And again, this is not direct financial advice or anything like that. This is just my opinion on what one would maybe want to do and personally what I'm doing. And there's three main things. One, if you have any speculative stocks that are not free cash flow positive, so basically they don't make any money, if it was me that owned those stocks right now, I would cut my losses. It hurts to sell a stock at a loss. In fact, most people will tell you never sell at a loss. But you know what? Sometimes you have to. There are certain situations where it is justified. One being you invested in the company for a reason and fundamentally something changed. But me personally, I don't even invest in speculative plays that aren't free cash flow positive. So you won't catch me in this situation, but I am just pre-warning, if I was in this situation, I would be thinking that with market volatility continuing and a correction on the horizon, a speculative stock for a company that's not even making any money and isn't free cash flow positive is going to get hit the hardest. That is the one situation in this market where I would cut my losses, is if I had a speculative play like that doesn't make any money, because guess what? It's going to continue to get hit hard. It's the kind of play where if we had a 10 to 15% correction, a stock like that that's very speculative, risky, and doesn't make any money might get hit at more like 30% or more. Two, if I have an investment that is a smaller market cap company, it's going to get hit harder but I'm not going to sell out of a stock like that. Now let me explain, because that may sound a little similar to what I just said before for a speculative play, but it's not. I do personally have a couple investments into smaller market cap companies, but this is based on actual analysis, valuation, a DCF model. I bought into these companies, and based on the numbers, to me, they were undervalued. So as long as my philosophy for that stock when I bought it stays intact and nothing changes fundamentally, if we get deep enough into a market correction, to me, it's just an opportunity to buy the dip. Again, just to establish the difference between what I'm saying now versus a speculative play is, if it's speculative, I never had a valuation on the company. I'm just taking a gamble. So you're really going to get hit hard in a market correction or market crash. But if I ran the numbers on a smaller company and I liked what I saw and I thought it was undervalued when I bought it, I'm not going to panic sell and sell at a loss if it goes way down. That's the kind of investment I will instead double down on if it goes down enough. And 3, and probably the most important thing in my opinion that one should do, and what I'm personally doing in this market volatility, where I do believe that at least a correction is on the horizon. You need to have enough stock portfolio diversification where you're including value stocks. But not just any value stocks, undervalued value stocks. Remember, when you have market uncertainty, market volatility, and a potential correction on the horizon, guess which stocks get affected the least? Yeah, it's value stocks. Bigger market cap, value stocks always get affected the least. Those are the kind of companies where on these really red days, you may only see them go down like 0.5%, 1%, 2% at the most, and they may even have their own little recoveries too. And yet you're seeing speculative plays get slapped for like 10% in one day. I will share that personally one of my value stocks I'm invested in that has held up extremely well in these market conditions is AT&T. If you want my thoughts on AT&T, I made a video on it. I ran a DCF model, went through the whole shebang, and to me, the stock is undervalued. So an undervalued value stock with a higher market cap that's not going to get hit as much by this market volatility, you should have companies like that into your portfolio. Give your portfolio some diversification in that regard. So that way, if we do end up having a market crash or a market correction, and let's say the market drops like 10 to 15%, your portfolio is probably going to mirror that sort of drop overall. And meanwhile, if you're littered with just very speculative plays that don't even make any money, your portfolio could drop like 30%, 40%, you never know. Okay, so let's recap the 3 ways on which I'm tackling this market volatility and the potential for a market correction on the horizon. 1, I am not in any speculative plays that don't make any money and are not free cash flow positive. To me, that's just way too dangerous. I already don't do that, but that is really playing with fire in a market like this. 2, if I do have any smaller market cap plays, but it's something that I already found was undervalued, I'm not going to let the market scare me off on that because I ran my numbers and I know what it's worth to me. So I'm not going to panic sell on a stock like that. Instead, I'm going to wait, and if a market correction really does happen and those stocks go down enough, that's just a double down opportunity for me to buy the dip. And 3, you should most certainly have enough diversification in your portfolio where you're including some value stocks. That'll hedge nicely against market volatility and the potential for a market correction or crash. It's going to fill your eyes with less tears if a major correction does happen. And I want to reiterate, these are value companies that you should be looking at that are coming in at undervalued based on analysis that you've done. I hate to give this example, but based on the numbers right now, and I've run a DCF model on them before, Apple may look like a value stock to someone because it's a bigger company and doesn't tend to move that much, but it's not undervalued. Based on the numbers, it's actually a little overvalued right now. So that is not a stock I would personally buy into to hedge against this market volatility. I mean, don't get me wrong, it'll still do better than a speculative stock, but if you're looking to hedge against this market volatility and a potential crash or correction, you want to invest in value stocks that are undervalued. That way you're truly protecting yourself. There's not going to be much volatility on the stock, and it's going to give you nice upside potential in the future. Okay, everyone, that's going to wrap this video up. I hope that it helped give you some perspective on how you would maybe want to tackle this market volatility and a potential correction on the way. Again, not financial advice, but more so me putting out my opinion on how I would tackle these market conditions. Okay, everyone, and with that, peace out. Have a great day.